Hey guys, what's up? It's your man Pete. I have no idea why I'm holding this. And I got a viewer request and suggestion for a new video, and I thought I would answer her question here. And so the viewer, Diana I believe, she wanted to know how she can best prepare herself because she's thinking of buying a property, 1 or maybe 2 years in the future. So she wanted to know what she needs to do now to prepare for a seamless home buying process. I did some videos in the past talking about money and personal finances, how to prepare your savings and your down payment and your cash. And I even made a video about how to improve your credit score so that it would be easier for you to apply for a mortgage and get a loan. But I guess there was a gap in my content where I didn't put it all together and give you tips and advice and strategies on how to prepare better, if you're not ready to buy right away, but maybe you're ready to buy in a couple of years. So thank you, Diana, for bringing this up, and here's the video dedicated to you. Okay, so no surprises here, but I'm going to focus mostly on the financial part of things because, of course, without the finances and the money prepared, you're not going to be able to get a mortgage. And without a mortgage and a loan for you to close the property, then you're not going to be able to secure and buy your first home or condo. If you're independently wealthy and extremely cash rich, money is literally pouring out of your butthole, then you definitely need to call me as soon as possible and we can help you invest your money wisely. And while I'm going to say I'm not a mortgage professional or underwriter or bank and lender, although I did work at TD as an intern in my early 20s once I graduated university, because of my years of experience in real estate and helping people navigate and deal with their finances, as well as helping them to find their home, I built up and acquired some nuggets of information and knowledge that I can share with you in this video so that you can better prepare yourself and be a little bit more organized before you buy your place. I'll share with you some of my best pro tips on how you can prepare yourself, when it's really early for you and you just need to take care of some other housekeeping things before you actually start looking at properties. But we'll see you guys on the other side with that type of information right after this. Hey, subscribe, do it now. I promise you won't regret it. This is going to be a really good one. Okay, so there's probably a lot of you here on my channel that are, you're in your mid to late 20s, maybe early 30s, and you're really seriously starting to think about purchasing a place. Maybe you're not exactly ready to do something right away and you want to plan a little bit better, or maybe you want to get a better job so that you can have a higher income and be able to afford the place that you want to get. Because truthfully and honestly, you don't have to do it this way, but there's some people that are, incredibly hyper organized. They want to make sure that all the I's are dotted and all the T's are crossed. And so this might give you a bit of a primer in terms of how you should best set up your finances and even your employment so that you can make it a smooth and seamless transition when you actually are ready to purchase something, because that's going to be a whole other different process. So it's important to do these few vital things that will not only make the mortgage process easier, but it might actually even help you save some serious money in the long term, such as through lower interest rates, better lending criteria or better lending options, just preparing yourself because you're going to be dropping a whole lot of cash on your first property. But I'm not going to go into any specific details about property prices, but this video is really about helping you to position yourself so that when you do go for your mortgage approval, your bank or your lender looks at you like this. Okay, so first things first, and this is in order of importance, okay? Employment. Employment is the most important thing when it comes to getting a mortgage because you need to have income coming in and you got to be able to save some money. Banks and lenders, unfortunately, really don't like people who are unemployed, underemployed, or even self-employed. They love people who are getting a solid paycheck every single month consistently for years on end. And for the most part, you have to be at your job for at least about 6 months because you have to get past the probationary period. Now, it depends on, different companies. Some companies, their probationary periods are like 3 months. Some of them are like 6 months. So the key here really is that you need to be in a stable job and position, I think, for at least 6 months to a year. Because look, a lot of things can happen, right? A company can downsize and start cutting people out. Maybe you entered a job that you really don't like and you might actually want to change, or you don't like your manager that you're working for. A lot of things can happen and a lot of shifting happens. And so the banks, lenders, and underwriters, they know this. So they're looking for people who are in a stable position, earning decent income, and they're having consistent income coming in every single month. So the pro tip is try not to change your job in and around the time you're about to do your mortgage. You can change your job after the mortgage. You could literally probably do it a few months after, but just don't do it before. But if you're self-employed, it doesn't mean you can't get a mortgage or a loan. It's just that their lending criteria is a little bit different. Like you may have to put up more cash up front, and you may end up having to pay maybe a slightly higher interest rate or a little bit more fees. Like even for me, I'm considered a self-employed individual and I actually have my own company, but they don't view me as strong as, say, somebody who is a director or a VP at RBC. But if you're self-employed, there's always ways around it, and I can always hook you up with the right mortgage professionals to help you fix that problem. So overall, from an employment standpoint, the higher the income, the more consistent the income, the longer tenured you've been at your position, the better it is. And then on the topic of savings, what you can do is you can certainly use cash, of course. We obviously recommend people putting their money into some investments that's helping them make money, even if it's just like a mutual fund that's earning a few percent, because in a couple years down the road, it'll be worth a little bit more than what it is right now. It's better than putting it into a bank account, right? And then don't forget, if you're contributing to your RRSPs as well too, you can actually take that money out without penalty and use that towards your home purchase as a down payment. Truth be told, a lot of people in this city are getting help from family because simply their parents or other guardians or aunts and uncles, they've done really well on their properties. They've gone up a lot, and so they can refinance, pull out some equity, and they're giving this as gifts to their family members, to their kids, especially again when they're forming new households and getting married. Sometimes both sides of the family are providing money, and we have a lot of clients that are like this where both parents are helping out, and that is the down payment basically. But of course, you still need to save and contribute some of your own money as well too, right guys? Okay, now debt. Contrary to popular belief, it's actually okay to have some debt on your record when you're going for a mortgage approval. Some people think that you have to have a completely clean card, like no debt whatsoever. But in today's reality, it's a little bit challenging, right? Because people have a lot of student loans or car leases, of course, even a little bit of credit card debt. But then we also run into people who have a lot of cash too, right? Like they have a lot of cash, but they don't have a lot of credit history. And so it's a bit of a catch-22, right? It's like you've got all this money, but you don't have much of a history. That actually ends up being pretty high risk for a bank, lender, or underwriter as well too, because you don't have a long, consistent history of paying something every single month. And this is really important when it comes to mortgages, because you gotta pay your mortgage every single month. And it's a very large amount. Card payments are actually very helpful in terms of helping you to get a mortgage, because it's a large amount, and if you've been paying it for a couple of years, then you have a history there. And so you can become somebody who's credit worthy and trustworthy to lend you money on your property when you purchase. So again, for those of you who don't use credit or anything whatsoever, pick up a credit card, use it every now and then, please, at least, right? But what you really want is something that you pay consistently on a monthly basis. A student loan is something that actually will help you when it comes to a mortgage application, as long as you haven't defaulted and you've always paid. So in the mortgage application process or in the underwriting process, what they really hone in and focus in on is a thing called TDS and GDS, which is your total debt service and your gross debt service. So what these acronyms mean is they're a ratio, right? And they want to see how much of your income is being allocated towards expenses, towards other debt and liabilities that you have, and can you afford this mortgage based on all the things that you need in order to sustain your lifestyle. So if the ratios are too high, then maybe you won't be able to qualify. And so in those cases, what you want to do is you definitely want to make a focused and concerted effort in paying down your debts and liabilities. If you work with the right people, the right mortgage people, they'll teach you how to shift things around and help you prep yourself so that you're ready for a mortgage application 1 or 2 years later. Lately, what I've also been seeing a lot of is that younger buyers, especially single younger buyers, they're needing to get help from their parents or guardians, to be a co-signer or to be a guarantor for the property, because lenders are becoming a little bit more conservative these days as property prices go up in value. They worry about, single individual people that can't afford the property and end up defaulting on the loan. We are seeing more banks and lenders asking for co-signing and guarantor positions. So then that way, it's like if you ever run into trouble, they can always go after someone else to help you pay your bills. So if you're maybe 2 years out from purchasing a property, maybe at the 1 year mark, you may want to give some heads up, especially if you think you're going to be purchasing a property alone, then you might need a little bit of backup help and support. They probably won't end up helping you pay your mortgage, but it's just nice to have somebody on the application to sort of back you up and give you a little bit more security and give the bank a little bit more security. So credit scores. Yes, credit scores are pretty important for lenders. Basically, if your score is about 650, mid sixes around there, you can still qualify for a mortgage, but you may end up having to go to a B lender where you're going to be paying additional fees and the interest rate is going to be a little bit higher because you may be considered a bit more higher risk. What banks and underwriters are really looking for are people who are 700 and up. 700 and up for a score is someone who's very reliable, somebody who has a good history of paying their bills on time. But of course, if you can get your score up to 800 plus, then you're going to be considered a very premium clientele, and a lot of banks are going to be interested in working with you if you've got a score and a history in and around 800. What I would suggest you do if you're 2 years out is to pull your credit report. Go on to Equifax, go on to TransUnion, maybe even start using Credit Karma. The point is that you actually pull it out, start auditing it, start looking through through it, see if there's any inconsistencies, see if there's anything that doesn't belong to you, especially if you're in a culture where there's a lot of people that have very similar or the same names as you. Sometimes those files, they get mixed up. And so it's important for you, and it's your responsibility to go into your file, look for things that might be affecting your score or affecting your history, so that you have some time in 1 or 2 years to be able to resolve and fix any of those issues before you're going for your mortgage. Again, this is a really crucial step in helping you to get a loan and a mortgage much easier, to avoid any sort of uncomfortable hiccups. And in the end, it's gonna help you save a lot of money if you can get a preferential interest rate. So if you're getting a bit of help from family, your income and employment is stable and your credit is, decent, and you're ready to make a move, then you should definitely give us a shout here at Selling Toronto. We would be happy to help you review your situation and give you a course of action that best suits you so that you can get into the game and start taking advantage of these enormous returns that we're seeing in the market in Toronto right now. And then hopefully we can help you achieve your dream of home ownership here in the Greater Toronto area. So if you like this video, please be sure to hit the subscribe button, throw us up a like, leave us a comment. It really helps us out with the YouTube gods up there. And we really appreciate you watching and engaging with the channel. Thank you all very much. I'm incredibly grateful and touched. And we continue to march towards our goal of 5,000 subscribers, hopefully by the end of the year. Thanks again, and hope this video was helpful for you, Diana, and we'll see you guys in the next one. Bye for now.